Dear friends, thank you for supporting this channel on Patreon to join our growing family of donors, now 59 patrons strong. And remember, once we reach 100 active patrons, we will start sending out a 1-ounce U.S. Silver Eagle, autographed by your host, Donegan Kaiser, to one active supporter each and every month. Thanks for taking a minute to pitch in by going to patreon.com/ReluctantPreppers and pledging your support today. Thanks very much.
Hey Reluctant Preppers, this is showing you just how easy it is to purchase silver without paying any premium over spot price. You just go to sdbullion.com/RP, scroll down and enter the special code to get silver without any premium, and they'll mail it to your mailbox, discreetly packaged. Inside you'll find a beautiful 10-ounce bar of fine silver, and you are able to purchase that and have it and add it to your stack and your collection without paying any premium, and you're supporting Reluctant Preppers along the way. Thanks.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We have a returning guest today. Lior Ganz is the founder of Wealth Research Group. He's been with us a couple of times before on Reluctant Preppers, talking to us about breaking events in the financial markets, and specifically gold, silver, and some of the cryptos and other emerging strategies for layering your financial fortress. Lior, thank you for joining us again here on Reluctant Preppers.
Hey, thanks for having me.
The last time we spoke with you, we were actually meeting up in Israel when we were there over near New Year's, and you were talking to us about some game-changing aspect of blockchain and crypto, and some companies that are doing some mining for various types of cryptos, and how to participate even without owning cryptocurrencies directly. And we have to ask you on a follow-up basis here, since we've seen a recent dramatic smackdown of crypto prices from that run up to almost 19,000 in Bitcoin to now less than half of that. Some people have pointed out that over the life of Bitcoin, this is kind of life as usual. This happens periodically. It tends to have a volatile life, as some young new industries do. But we're just checking back with your particular perspective, since you are talking to lots of people in this space. First of all, what do you think is really going on with this recent smackdown of cryptos? And secondly, what do you see ahead, more midterm and long term, for the blockchain and hashgraph and other technologies? Are they truly going to be a game changer in the decades ahead? So if we could start first with this immediate market action, what do you think is driving it?
Yeah. What's important to understand is if you take a look at Disney cruise, for example, a huge yacht, right? It's sailing through the ocean. It's not going to be affected or impacted by waves as much as a small boat will. A small boat will rattle. And if you think of this analogy, that is the analogy between what we call efficient markets and inefficient markets. So an efficient market is a market where it's saturated with knowledge. People know about everything you can about the asset classes that are in this industry or in this sector, and therefore you can think of it as a giant yacht, and you can think of the waves as underpricing and overpricing. And this yacht will not move much. So trying to grab opportunities is incredibly difficult, because that market is usually fairly priced. If you're an investor, that's one way to make sure that you stay on course with the market. And many people, what they do is they invest in index funds, or they just try to follow the market, which is great if you don't have the time, if you don't have the capabilities, the skills. If you've assessed your own life and you think, hey, I cannot beat the markets, the only thing I can really do is make a lot of mistakes. Let me just buy an index fund and make sure that I have some money in cash and I'm good to go. My career, my income from other things will facilitate most of my lifestyle. I'm not looking to spend hours and hours on research. So efficient markets, they're better for these types of investors. Then you got inefficient markets. inefficient markets are markets that have only just started, or that the information is not accessible, or that there's not a lot of historical precedence, and therefore the intrinsic value of the assets that are inside of that market are unknown. It's very hard to judge them. And if you have brilliant insight, if you have skill, if you have luck, if you have a combination of all these things, you can make a lot of money. And cryptocurrencies are in that second basket. It's a very inefficient market, because obviously in December, the market couldn't have been right about 20,000, or in January, the market couldn't have been right about 6,000. One of these markets is wrong, correct? You can't have it both ways. It's not like this asset was worth 40% of what it was in December. One of these notions, Bitcoin at 20,000 or Bitcoin at 6,000, one of these notions is wrong. And so what you see is a very inefficient market. And the word inefficient has a negative context, but if you're an investor, it has a very favorable context, because it means you can take advantage of situations of undervaluation or overvaluation, or underpricing, overpricing. And so that is the premise of the cryptocurrency space. There's a lot of opportunity right now because of price exploration. The market is trying to see how much Bitcoin and other digital projects are worth.
Reminds me of the quote from Warren Buffett, the Oracle of Omaha, saying, volatility creates mispricing, and mispricing creates opportunity. It's what you're saying.
Well, yeah, and not only volatility. Volatility is an effect, but the cause of it is that the market doesn't know what is going on. So the market is trying to find the fair value of all of these assets. Remember, these assets don't cash flow, they don't create profits, they don't generate revenue. You're buying into a project which increases in price when it's less risky to own it, and when the technology of it is getting better. And I think we talked about this the last time. The word cryptocurrency is very misleading, because if you think of the US dollar, you're not waking up and checking the news every day to see if they're hard forking, or if there's a new technology in the network, or it's not a technology, it's a real currency. It's a currency. It's a fiat currency, but it's a currency. Bitcoin is a technology that that can be used to for the purposes of a currency, but it's a technology, and it's a very different environment. And because it's different than currencies, it's different than gold, it's different than stocks, it's different than all of these other asset classes. And because it's different and it's very independent, I think it has a very good future if technology-wise it still helps people solve problems like fast transactions, borderless transactions, anonymous transactions, all the things that cryptocurrencies are great for, outside the reach of government, decentralized, etc. All of these things are positive, are net positive, as long as the technology stays good, and because the technology can be bad, and then fees are higher, verification times are slower, etc. So if the technology is still good, overall volatility for your portfolio is actually lessened if you own cryptocurrencies as well, because cryptocurrencies can go up or down, while your stocks, real estate, bonds, precious metals, cash, etc. are very correlated with each other. This is a very independent sector. So you're actually lessening your overall volatility by investing in them. And I think that is the reason why Wall Street will get their clients looking at cryptocurrencies going into 2018. Wall Street, remember, it's very institutionalized. Regulations are favorable for institutional investors. And so what's going on right now, this regulation spree for cryptocurrencies is shaking out a lot of the money that was involved in these cryptocurrencies for anarchist purposes, or for any type of really shady purposes. And they've pulled money out, which is one of the reasons why you see the price going down. But on the flip side, new money is coming in. legitimate money. Obviously, nobody likes Wall Street, per se, but in terms of what they can bring to the table, their purchasing power in an environment like cryptocurrency, where if you bring a surge of money, it immediately impacts the price, because you can't mine, you can't just create more credit or more bitcoins out of nothing. It needs to have a reason, and the reason is legitimate transactions. So the beauty of this is, once Wall Street comes in, the price will be positively affected. And in the meantime, we're seeing Bitcoin and all these currencies trying to filter through this regulation spree. And obviously, remember, people have made a lot of money, so they're taking profits. They need to pay taxes. This is coming due because April 15th is just around the corner. All these factors come into play. And the bottom line is, it's an inefficient market, and therefore expect a lot of these situations in the future. What is not under questioning, and what is getting better regulatory platform, is the blockchain technology itself, but it's very hard to monetize it. So it's companies that are able to create a situation where they are making profits or generating revenue from blockchain technology itself. That is something that's only getting started right now, and so that's not under the regulatory spotlight right now. It's not even a question whether or not blockchain technology is regulated and fine, and the authorities are okay with it. It's the question of these cryptocurrencies. Just because 70% of ICOs in 2017 went to zero, and therefore authorities need to protect consumers and investors from scams, from actual people that are just gone one day. So this is very important for markets to have this sort of a parachute, and ICOs are lacking it right now. Cryptocurrencies, they still lack it, or digital assets, they still lack it. So we'll see. It's a nice battle to see what's going to happen with it. But in terms of going forward, 90% of these cryptocurrencies cannot coexist. There's absolutely no reason that to think, even rationally, that there's 1,500 technological differences between these 1,500 projects. So most of them will get out-competed by the rest. It's just going to happen. So whenever a market gets started, a lot of people come up with ideas. They go in because there's a lot of interest, so they can create companies and create projects, because there's money that on the other side that wants to take a dip or a dabble. But once that money starts to understand, hey, I don't want to speculate, I want the real deal, some of these projects will go away, and you'll be left with probably 10% of what's going on today, which will make the market much more effective and efficient, but less opportunistic. So it's always a balancing factor.
We wanted to also circle back with you on, by the way, thank you for that, I think, very level-headed assessment and quite enlightening about cryptos, because so much of what we hear about cryptos, it just, if you search like Bitcoin prices news on a daily basis, it's like whatever. You see the news stories always have these beautiful graphics of either a skyrocket or a balloon going up, or a rock falling through the floor, depending on which market in the last day. It's like I love
Cointelegraph.
Bipolar news reporting on this, and to have someone actually talk to us about kind of the fundamental factors that are going to be driving this over the long term is actually quite refreshing. So thank you. Wanted to ask you another question that we typically will circle back with you, and that's having to do more with precious metals. Although I first have to ask you this question, it's more about what many have reported in the independent media, different news sources reporting that we are in the early stages of what could be described as a global financial revolution, of turning away from the powerful financial elite, whether that's international bank owners and the high-level deep state government officials who have been in collusion with them for a century or more, depending how far back you want to count, to reclaim sovereignty from that ruling elite. And some people are saying we're going to see changes that they're already in some things are happening. So they're pointing to things like some of the tax law changes about repatriation of funds and foreign tax and tariffs that were made by the Trump administration in December, changes about being able to seize assets of actors that seem to be acting against the interests of the United States, laws that seem to be coming about the ability to go after those funds and freeze the funds of people that are maybe acting against the interests of the United States. And people are saying, are all these the early signals that we're about to see the potential of a convulsive change this year, and what actions should aware individuals consider to weather out such a sort of a financial revolution? Just checking with you to see if you have also been hearing any of these kind of early signals that this year is potentially going to have a lot in store as far as major changes in both power and wealth, freedom for individuals.
I don't think so. The fundamental ignition for changes, for meaningful changes, is pain. And 2008 was very painful, but you still saw that most Americans did not go to the streets and did not contest when Wall Street received trillions of bailout money, when central banks created trillions in QE funds, and we taxed future generations. I think in the US overall, there's for the majority of the population, there is sort of a state of mind that the government is so big and it's too big to fight. It's too, no one wants to go through the pain and price that it takes to go to the streets. They think it's futile, and for most of Americans, they think it's futile to fight the federal government. They think it's such a hard-added machine that nothing can really help unless hundreds of thousands of people are in the streets, and no one wants to be the first to try and build this this movement. And so most people are just going on with their regular lives, and they take hits as they come. So most of people are becoming indifferent, and that's it's negative, but it is what it is. Even the core gold bugs still use dollars, right? They don't say, okay, I'm banning dollars out of my life. I don't want to use dollars. I'll just use gold. Well, let's see what or silver. Let's see what the ramifications are. Because in the crypto space, there are a lot of people who say, I'm just going to use crypto. It's happening. People are draining their bank accounts, and they're out of the fiat world, and they're just using cryptocurrencies. But with all the difficulty that it comes with it, they're actually walking the talk, right? But on an overall basis, it's very hard to see a revolution happening when consumer confidence is at an 18-year high, when small business confidence is at a 30-year high. People are positive about the future for the first time in many years. People think that the next 5 years will be better than the last 5 years. So when you have that sort of an environment overall in the US, that is not an environment where revolution occurs. But it's an environment where the president can act much more swiftly and much more rapidly on his agenda, because his approval rating is going up, and nobody wants to be the congressman or the Senate representative that questions a president when his approval ratings are on the rise. So whether it be the tax cuts, they're approved already. I think the tariffs, which if Obama would have proposed tariffs, that thing would be out the window. Nobody would agree to that. But here you go. Trump is going to put into effect tariffs, which are isolationary policies, and they're definitely historically not a smart thing to do. Who knows? Nothing is set in stone. This could be a positive event, but If you remember, most people don't even know this, but 700 and 800 years ago, the United States of America, of that world, was China. China was the richest dynasty probably of all time. And then they said, okay, you know what? Let's keep all of our secrets to ourselves. Let's not share anything. Let's not do commerce with anybody else. Let's build a wall and just enjoy our prosperity. And the second they started building that wall that isolated them from the rest of the world, they went into a demise and got to a point where 30, 40 years ago, they were the poorest country on the planet, right? So, the fact that they didn't do commerce with Europe and didn't allow people into China 600 years ago pushed them back into the past and made them from a rich nation to a poor nation. And I hate to see that happening with the U.S. What the U.S. needs to do is find its identity in the global market. And the U.S. has a lot of quality. They can't compete in price with many countries, but they definitely can compete in quality. And that's what they should do going forward. They should find and focus on quality and not on pricing. There's 46 countries right now that are cheaper to produce goods than China. So if you got a quarter of the world that's already cheaper than China, the U.S. doesn't want to compete in that market. It wants to compete on quality. And that's what I think they should do going forward. And I think the U.S. badly needs an infrastructure revolution, which Trump is proposing. The infrastructure in the U.S. has not been handled properly. Anyone who's driving the roads, or you just need that. It's part of what makes people confident in their government, what makes people feel good and trust the economy and expand, etc. What I think is going on in the U.S. right now is there's a huge demographic shift into retirement. People are retiring every 10 seconds. Somebody's celebrating his 65th birthday, and so what's happening is a lot of skilled labor is exiting the workforce forever. And there's a need for skilled labor, but the millennials are still not very capable of getting to the levels of people that have worked in some of their jobs for 40 years. So obviously a 22-year-old or a 25-year-old doesn't have the same quality as a 65 or a 60-year-old or a 55-year-old, right? So companies are needing to raise wages across the board in order to find skilled labor, to attract them to their companies. There's about 8 million openings in jobs in the U.S. which are unfilled because there's not the labor there in place. So for the first time in a long while, you're seeing wages increasing in the U.S. And that is something that is productive for the person who's getting the raise. But overall, it's creating an environment in the U.S. that hasn't been here for a while, and that's an inflationary environment. Because if you take a look at tax cuts plus a raise in wages, people have more discretionary income, and in an environment where people save about 2 to 3% of what they earn, and now they have more to spend, that can create a velocity of money. And in a society as advanced as the U.S., even a small uptick in inflation is detrimental. The U.S. economy works and the stock market works only when inflation is tamed and unsurprising. If it starts to surprise, then CEOs cannot plan to the future because they don't know costs, expenses, they don't know margins, they don't know if they need to fire or hire, they don't know if they need to conserve capital or spend it on machinery. Inflation is a bitch when you look at big economies. When you look at small economies, it devastates them. That's it. They're gone. As soon as inflation appears, currency crisis happens, commerce goes wild, people are going and becoming much more violent and desperate. But in an economy as big as the U.S., with more market players, it's easier to contain inflation. You've never seen a real giant problem to the dollar yet. Even in the 70s, when inflation went berserk, they finally were able to tame it. And so they're very scared about inflation, both the central bank and the government. But and this is what I told X22 Spotlight 2 weeks ago. I think they're in a collusion with each other, because on one hand, the central bank, what it needs to do is make sure that inflation doesn't spiral out of control, but it needs to raise rates in order to curb that. Mm-hmm. And on the flip side, you got the government who just lowered taxes, and that means if it wants to keep spending, it needs to go into bigger deficits, right, which means they need to make higher interest payments. And if you raise the yield on the treasuries, then that's counterproductive for them, because the borrowing costs are getting bigger. So this is not 1980 anymore. The U.S. is not the larger creditor nation in the world. It's the larger debtor nation.
Yeah.
And so you just can't. You got to balance these out. And the only way to balance them out is to start cutting on entitlements, which is the politically hard thing to do. So it's a huge mix, and it's going to be very interesting to see how these three factors come into play. The private sector, which is now seeing, boom, I got all this disposable income because my taxes were just cut drastically, and boom, companies are fighting for me. I'm getting higher wages. And then on the flip side, you got the government who wants to keep spending, and their tax revenues are going down, and they can't just cut on entitlements, because that's a quarter of the population that's going to be hurt. And they're already in trouble because most people can't afford retirements. And then you got the central bank, which is, sort of a quasi-government institution, and they need to make sure that their policies of lowering interest rates for all these years do not come back to haunt everyone. And so they need to raise rates and not be blamed for a decade of mismanaging and having a bad policy in place. So these three things are all coming together right now, and it's going to be very problematic. But before that, from 2008 until today, everyone was going together. So you lowered interest rates, right, which created a situation where companies were able to borrow and ignite the economy. The money didn't go to Main Street, but obviously every year the U.S. was getting a little bit better than compared with 2008. So it wasn't a recovery like people are used to in the U.S., where it's like a U-shaped recovery. No. But definitely people were year to year feeling less fearful, and the economy was starting to balance out, and the government was able to work in a low interest rate environment better than before. And remember, the U.S. is not a vacuum, right? Other nations are looking at what the U.S. is doing, and they need to follow suit. When the U.S. is sick, the world sneezes. It's an important thing to understand that it's not this is the global economy. So when the U.S. Central Bank lowers interest rates, the ECB must lower interest rates. It's not like they can keep interest rate at 4 or 5%, because that will make the euro much more attractive, and that will make their export economy less attractive, etc. It's all a huge butterfly effect in the global economy. So this is the first time where you see the U.S. doing something that Europe is still not doing. So the U.S. is raising interest rate, Europe is still not, right? And so money is moving into the dollar on one hand, because it pays better interest rates. But on the flip side, people are worried about inflation, and institutions are worried about inflation. So very interesting situation.
Yeah.
And
so you're not seeing a revolution, but you're seing an interesting collision course here between banking and the private sector.
And let me tell you what Ray Dalio alluded to a bunch of times, and he was very made famous in the media a few times for saying it in the past month. But I want to make sure that people understand this. He's talking about a situation where treasury bonds go from, let's say, 2% to 3%. It's a 1% rise, right? But in terms of percentages,
50%.
And so what does that mean? If I go into the treasury market and buy $1 million worth of 10-year treasuries today, and they yield, let's say, about 2.2%. That means my coupon payments or my interest payments on that bond will be $22,000 in 2018. Now, 1 year from now, if that same 10-year bond pays 3.2% or 1% higher, my coupon payments will be $32,000. And so when the previous investors who has 2.2% written on his face value bond tries to sell it to the market will not pay him $1 million, because for that same $1 million, it can now buy 3.2% treasury. So the face value of his bond has now gone down by about 34%. Mm-hmm. Who owns bonds? Central banks, governments, and pension funds. Mm-hmm. So the biggest and sovereign wealth funds, the biggest institution in the world are the ones that are at risk here. Who can bail out these sort of institutions? It's only organizations like the IMF and the BIS, so the Bank of International Settlement. Only international type organizations can bail out sovereign nations. So, and that's what their mandate is, right? To make loans to these sovereign nations. So if you are fearful of this idea of a one world government or an international coordination between all governments to create a seamless currency that runs through all nations together, that's going to be the only time where this kind of an idea can float. If governments and central banks will need a bailout, then their mother is an international organization. So if the population doesn't put that idea to rest, whenever it pops its head, that's going to be something that's going to be floated around, and that's not good for anyone, unless you think that's a good idea. I personally think it's a very bad idea, just because of the people that will be running it. So a bonds Armageddon, which I believe is coming in the next 2 to 4 to 5 to 6 years as interest rates rise and inflation level go higher, will affect not just the layman, not just homeowners, like in 2008, where homeowners lost the equity, and you can bail out the institutions that can make loans to these homeowners and get the economy back in shape, so to speak. Obviously, because you need to take into effect that it created huge debts. But this time around, it's the actual framework of our economy, the institutions, because the Federal Reserve now owns 40% of the assets of the GDP. So it's a huge institution. It's very, very strong. And when it's shrinking its balance sheet right now, it's trying to sell its bond portfolio. That is something that we need to think about real close. And that's the reason, by the way, why we created a special report about what to do with your bonds portfolio and how to switch it over into high-yielding instruments that work well in a raising raising of interest rate environment and in a rising inflationary environment. You can go to our website, wealthresearchgroup.com/bonds, and it shows you why bonds are absolutely horrible in these types of environment, and what sort of companies and assets are very favorable in these environments, especially for retirees, because these instruments pay between 8 and 11 and 12% a year yields.
And I think to even underscore what you said even stronger, you mentioned that if sovereign sized players start to need to be bailed out, the only people that can do it is international organizations. But isn't it even more serious than that? Because, as you pointed out a little bit earlier, all of these countries have been playing by the same playbook. I mean, if the U.S. and the ECB and Japan Central Bank and all these have been cutting their interest rates, and then they all start to have to raise them in unison because they're all linked and they can't just run individually, then it isn't just going to be one country needing bailout. It might be most or many that all get into financial distress at the same time, in which case that international body, if it's really just funded by those same countries in the first place, even though it may have a charter, it may not have the ability or the capacity to bail out all these countries.
Well, remember, just in the bottom line, what has happened in the world since 1971? basically, since everyone went on fiat currencies, that has allowed governments and individuals and corporations to simply leverage. Everyone, as in general, is working on debt. Everyone, all across the world, people have used debt and credit to build tangible things: skyscrapers, roads, bridges, manufacturing capacities. We are all living in a giant bubble we don't even see, because it's obviously nobody even thinks about it. But in the end of the day, we have all enjoyed this capacity to live beyond our means as a planet, just because we are not paying back all this debt. This debt is just the interest rate is getting paid back. The principle for all of these countries, for all these governments, they don't pay down the principal, just the interest payments. And so when they need to restructure their debts, all of this wealth will still be around. It's not like people are going to say, okay, that skyscraper was built on margin, let's pull it down, right? So all this wealth that is around the world, especially in the Western world, obviously, is going to stay there. But the problem will be, what is going to happen with all of the debt? Who is going to be taking the haircut here? Who's going to be needing to clean his books? Who's going to falter? Who's going to go bankrupt? Who's going to go to jail for mismanaging and embezzling, basically, their own country or their own funds? Who's going to be accountable for all of this? That's the real problem, because when you create credit through a fiat institution or through a decree like central banks, you're creating purchasing power that the rest of the world can use to buy tangible items and to pay for services, etc. So this is essentially a leveraged way to live that has no consequence until it has consequences. And so the only question is, what will happen when this entire structure faces the consequences that it must face? So this is a and it's a global bubble. It's not like you can find refuge anywhere. And so that's why the need to own assets that are outside of this system is so great. That's why I own precious metals in the physical form, because that is something that can't be. It has no counterparty risk in terms of governments or of fiat currencies. It's not related to them. It's not within that system of credit. You own it. It's outright yours, and different from buying a car or something that has. It's also outside the system, right? You can still sell your car and make money, but that car goes down in value every year. If you buy a piece of gold, that doesn't change at all. It's still the same piece of gold 2,000 years from now. It doesn't deteriorate in its value. It's an ounce, right? And that's why it's a great store of value outside of the system. So if you're thinking of what to do in terms of how to protect at the most fundamental level, that's why gold and silver are great. They're universally accepted. All nations, all people know what they are. They have a fair market price that people have used for centuries. And I don't see any reason why not to own them. So if there's a question of why to own them or why not to own them, the cost of owning them, and that the world keeps on going in the same way, and there's no crisis, and you own your gold. What's the negative side of this? So you own some gold. It's not like it's gonna become a problem ever in your life. You're not gonna say, "Oh, that gold is costing me too much."
Right, but let's hit. As long as you're on that question, let's talk about that, because people have been even devoted gold bugs who are very concerned about those systemic risks that have been building up for a decade since the 2008 collapse, etc. Who have already made the commitment, as you pointed out, to already take a position and protect themselves with a strategic percentage of their wealth protected by precious metals, have been discouraged in recent years because of the languishing value in compared to other places that they could have been putting their funds to work. They see the stock market booming or different things going up, and then their gold just seems to be sitting there. People argue about whether that's due to suppression or not, but regardless, you're right. The intrinsic hedge there still remains, but the question is, there's this opportunity cost. So are there balanced strategies people can be at least aware of to increase yields of in the precious metals space, other than just stashing your precious metals away as a hedge, which has its place, but are there some other things they should be aware of?
It's a great question, and I think you're touching on a very good subject, because most people, when I speak to people that own gold, they have this need to be proven right, and you've got to eliminate that from your life. You don't need to say, hey, I told you, huge crisis, here you go. That's not the point of owning gold. You're not in a competition with other people to see who is correct, who's right about what's going to happen with fiat currencies or what's going to happen with inflation, etc. Own gold at about 4 to 7 to 8% of your net worth, no more, no need. Or the way I do it is I just have 2 years worth of fiat currency expenses in gold. So if my lifestyle is, let's say, 10 grand a month, then I own about $240,000, which is 24 months in physical gold and silver. So that way I know that I have enough ounces if something ever happens. Now, if you own only 4 to 7% or 4 to 8% of your wealth in gold, you can increase that obviously if you see more problems. But if you own that, or 2 years worth, that's enough. How much insurance do you need in your life, right? You don't need 10 policies on life insurance. You just need one good one, right? So the people that are trying to make money off of gold and make profits off of gold, the spot price of gold is not the place to be. And I think that's what you're asking, right? People are saying, okay, I own all this gold, but I'm not making profits.
Right.
Well, why are you trying to make profits on physical gold and silver? The fact remains that the only reason you'd want to sell your gold and silver is if the world becomes such a disastrous place that people only accept your gold and silver, and they don't accept any form of other payment, and you need to actually pay for stuff with it. So if nothing ever happens, that gold should be passed on to your children. That's the ideal scenario, where you never use it, where it costs you that opportunity cost, but you were protected. Okay, so it's just like with insurance. You go and rent a car, right? They tell you, hey, do you want to have insurance with that car? You say, okay, either I take that $400 worth of insurance and I buy a fancy dinner and I enjoy more, or I protect myself, right? So it's always that balancing question, obviously. But in terms of your life, your family, and such, I personally believe that 2 years worth of gold and silver is enough, and that most people don't do that. So that gives me this sort of an edge. If something ever happens, then yeah, it might be that gold and silver become so overvalued and worth such a premium that will actually, that insurance policy will actually make you wealthier. And historically it has. In runaway inflation scenarios, people have used minimal ounces of gold and silver to buy prime real estate and in great locations, right? It has happened, but that is not the norm. That's the exception. If you want to use the gold market to become wealthier, the best strategy, if you look at history, has been the royalty streaming model. Miners are mining gold or developing gold assets or exploring for gold is a highly cyclical environment. It's a very inefficient market, like we said before, because these companies let's think of a company, and I'm sorry if my answers are longer, but
no,
you're asking sophisticated, educated questions, so I want to answer them more at length. Let's say you want to launch a company today. So the first thing you want to do, you want to raise money, so you're already taking on either debt or some sort of a loan to the company. Then you go and buy an asset. That asset is not producing anything. It somewhere beneath the surface, there might or might not be minerals. If you bought a grassroots asset, then it's really pure speculation whether or not there's gold there, or any other mineral. Some geologist or something surveyed that surface and he thinks that it's there. The other way to go is to go where it's already proven. So it's a proven asset underneath the surface, but you still need to find the main vein. You need to explore it. You need to develop it. You need to do all that stuff. All of this takes years and takes a lot of capital. So that company absorbs capital and burns it in the anticipation and the hopes that this will ever become either an operational mine or that it will get bought out by another company for a premium. So that is the way that you measure the worth of this asset, the worth of this company, of shares of this company. So it's a very inefficient market, because if the price of the mineral itself goes up, then obviously the asset goes up in prices, should go up in price as well, unless management is doing a bad job, unless the books are not balanced, etc. So mining is a very tough business. Even when you operate the mine, you don't control the price of the product that you sell.
Correct.
So mining is a very tough business. But on the flip side, because it's inefficient, it goes through cycles where people overvalue it extremely. And if you are able to patiently hold while people undervalue mining companies, sometimes for years, sometimes for a decade, it can be that if management was able to capitalize on this undervaluation and buy cheap assets when the light switches and people move to real assets and to small gold companies, and investors do that, it's all cyclical, then all that wait time will have been worth it many times over. So that's probably where a lot of frustration comes from, these long holding periods where you think, how much cheaper can this asset be? And then it goes 20% down or 30% down or 40% down, right? But the one thing that is far less cyclical and much more efficient and profitable is to go with the royalty model. I'll give you an example. Franco-Nevada, which is a company that I've owned since its IPO in 2008, has gone up 400% since then. It outperformed all miners, all ETFs, all managed money, all the brilliant people that sit around all day and try to figure out which companies will go up. If they only own that one company, it outperformed the spot price, it outperformed all the miners. Personally, I think it's about 22% overvalued right now to where I'm comfortable to increase my own position. But the royalty model is an amazing model, because what these companies do, think about Franco-Nevada, for example. It's a $16 billion company with 30 employees.
Wow.
Think of Barrick. They have like 30,000 employees. Mm-hmm. The difference in the way that they're structured is just incredible. And what these companies do, they make upfront payments to the cash-needy development companies or miners, etc., in exchange for a royalty stream at a fixed-upon price in the future from that company. So let's say Wheaton Precious Metals, formerly Silver Wheaton, they are able to create these streams where they buy silver for about $4 to $5 per ounce. And then they just immediately flip it and sell it at the market value, which is around $17 per ounce right now. So they make 400% on every ounce that they get. And so that's an amazing model, amazing model. And that's why these companies have outperformed anything else. So
the reason they're able to get those bargain basement prices committed to them for in the future is because they're providing upfront capital to the companies, and the companies that need the capital, the only thing they have to give is the asset itself. And so they say, okay, we'll give you the asset in the future for capital now.
Well, remember, not the entire, not all the ore body, right? But a percentage of that ore will be sold to the royalty company or the streaming company for a very discounted price.
Okay.
And sometimes the mine is much bigger than anticipated. That's all baked in the cake. So if that upfront payment is a fixed $100,000, whatever, $1 million, a few $1 million. If that mine happens to be bigger than anticipated, that royalty stream lasts for 20 years longer than anticipated, and that's even the bigger beauty of this. The upside is amazing. That royalty stream can last for decades, and it's all going to be at that same fixed price. So that's why I love that model, and that's why that model is very good. And the brilliant thing is it works great with commodities.
I was going to ask if you can apply that strategy in other areas other than precious metals.
Yeah, definitely. So it started with oil and gas. Then Pierre Lassonde and his partner started Franco-Nevada in 1978 when they said, okay, this oil and gas strategy can work in gold. And then in the early 2000s, another brilliant guy that I was lucky enough to be a shareholder of early on, LTS Minerals, started this with other metals, potash, coal, and other industrial metals. So they're using that model in that respect. But what I was looking for in the last few months is what commodity has never been tried to be royalized, right? This is just the term I use. What commodity is now exploding, and no company is doing the royalty model there, because remember, the royalty model is like a bank. The royalty company acts as a bank. They make an upfront payment in exchange for future, future arrangements. Not so different than a bank that makes an upfront payment to you in exchange for interest rates, right? So, but the royalty model is even better because that interest rate that payment is based upon business success. So if you're doing it with the right businesses, you're going to get much more than banks get back in interest rates. So in the last few months, we've been really racking our heads. Where can this royalty model be applied to? And it's in a growing industry. And so the commodity that we've seen that is exploding right now is cannabis, right? It's because it's going through this legalization period, and the year-on-year growth is about 25%. There is no industry that's growing at that fast rate. And so we've found a company that was private back when we started researching it, but now it's gone and it's publicly trading. So the fact is that investors can participate in this, and they are doing the royalty model in California. And what I love about them is they're not only tapping into the medical cannabis companies, but they're also creating royalty streams with software companies, companies that are in the cannabis market, but in the ancillary area. So companies that do not touch the process of producing and selling the plant, but they can do supply management or packaging or software for inventory, etc. And all of these companies will grow with the industry, especially in California. So I love that aspect of it, and that's why I think that company can do what Franco-Nevada has done in the royalty business in the precious metals, and outperform the price of the crop and the price of the share price of companies that are in the business of processing and excavating and selling the actual commodity, the actual product, because it's far less cyclical.
What's the name of the company you're describing that's doing this royalty model?
It's called Canna Capital Corp. It's trading in Canada and in the U.S. But I've been on this company for a few months. In fact, like an hour before we did this interview, I just got off the phone with the CEO just to get updates and all that kind of stuff. And we created a lengthy report, an entire overview of the company. If you want to tap our research at wealthresearchgroup.com/cannabis. And you can see the entire operation and what they do in California. they're only getting started. So these royalty streams are in startup phase. They're not even creating revenue yet. So all this revenue will start to kick in June, and that's when in June, July, they'll start news releasing that they're making money. And I think that is something that institutions will look at favorably, because this company is, what I really love here is the fact that banks are not their competition. Usually, if I'm a miner and I want money, I either go to investors to raise money, I go to the bank to get a loan, or I go to a royalty company. In this scenario, most investors, because it's federally illegal, they don't want to be involved in cannabis yet. Banks don't even want to open bank accounts to these companies, let alone give them loans. And so the royalty business is the only legitimate way for these companies to grow. And that gives Canna a great advantage, because if there's, let's say, 100 companies in California that need money to grow right now, they are only going to work with the best, because they can choose. Their competition level is very low. So that's why I think it's brilliant. It's a brilliant time to get to look at this company, because who knows how long it will stay federally illegal, and all these big boys, regional banks, community banks, and nation banks will not be able to enjoy this growth of legal cannabis. And many people have different opinions regarding cannabis. The fact of the matter is, if you're an investor, you got to think in a commercialized way, and work with what is already working. So that's one thing. But the second thing is, what I love about Canna itself is that they're working on the medical side, and there's so many people that cannabis medical products are helping and will continue to help. And in fact, it's been talked about a lot right now that 3 out of every 4 doctors are saying that medical cannabis can help a lot more than big pharma can.
Yep.
To many ailments.
Yep, we've had that's been a growing interest on our channel is basically healing yourself and finding natural cures for things, because there's so many risks associated with pharmaceuticals in many cases, and we have had a couple of guests on talking about that. We're actually starting a whole new sister channel soon at healingyourself.life, where we're going to be talking with a lot more about natural healing. Hey, Lior, we are out of time for this segment, but as in the past, if you would be so good as to send me links to these special reports that you've described, we'll put them in the description underneath the video for anybody who wants to follow up on that. This has been a wide-ranging conversation, but frankly, I sincerely appreciate, and I'm sure our viewers do, the depth and breadth that we were able to touch on today. So thank you for being so generous with your time.
Yeah, thank you as well.